today's presentation, I will aim to answer some key questions about the latest innovations and growth strategies in the global luxury watches and jewellery landscape. We will look at geographic prospects across the global market, as well as revealing some key industry trends and drivers in core emerging markets. Together with this, I will examine the influence of rising incomes, particularly in key emerging economies. Finally, I will sum up by looking at the key messages from this presentation. So our latest research indicates that the luxury goods industry has continued to witness a positive momentum, as indicated by luxury spending in China rising steeply despite a government clampdown on extravagant consumption, affordable luxury continuing to break ground, particularly in Western Europe and North America, and a rapidly expanding A, B and C class across many of the emerging regions such as Sub-Saharan Africa, Latin America and Southeast Asia, which is fueling a new culture of luxury aspiration. Looking at the market overall, driven mainly by strength in these emerging economies, sales of luxury goods exceeded $318 billion worldwide in 2013, representing a year-on-year real value gain of over 3% on 2012. We expect to see similar growth rates by the end of this year at around 4% in constant terms. So which categories and products are driving these sales? While according to our latest research, designer apparel clearly accounts for the lion's share of global sales at around 40%. Luxury jewellery and timepieces and luxury accessories were, however, the most dynamic. Both categories grew by around 5% in 2013, outpacing the wider luxury market. The $62 billion luxury watches and jewellery market accounted for over 20% of all luxury sales in 2013, making it the second largest luxury category behind designer clothing and footwear. This was a relatively resilient performance given firstly the crackdown on gift giving in China, the category's primary growth engine over the last 10 years, and secondly the economic headwinds buffeting much of Western Europe. The appeal of luxury watches and jewellery in particular is widening thanks to lower entry points, which we refer to as affordable luxury, and higher exit points or absolute luxury. The democratization of luxury has been an ongoing trend, especially in the US and Western Europe, and further growth is likely to take place at both ends of the market. This demand for affordable and high-end branded watches and jewellery has encouraged brands which traditionally have deep roots in apparel and leather goods, known as soft luxury, to expand into this category known as hard luxury. While French luxury brands Chanel and Dior launched their first high-end jewellery collection at the end of the last century, Louis Vuitton and Versace only recently added these to their portfolios to benefit from this untapped opportunity. And in a move to compensate for its underrepresentation in luxury watches and jewellery, iconic British luxury brand Burberry launched its first ever automatic watch collection last year, called the Briton, which ranges from an entry price point of around £700 to the limited edition 18-carat trench gold watch, which retails at around £10,000. More accessible luxury brands such as Michael Kors, Coach, Tory Burch and Kate Spade have also benefited from pent-up demand in this middle-class area for affordable luxury. While this demand in the affordable area has generally been the target for Western consumers, with some players losing steam in China, the new focus could be on China's middle class. So who is fueling this growth in luxury jewellery and timepieces? If we first concentrate on the markets themselves, according to our research, the top 3 countries in the $62 billion category are the US at 23%, China at 10%, and Japan at 7%. Together, these three markets account for over 40% of global sales. The US market is clearly dominated by women's jewellery, with similar business models in Japan and Russia. This, however, offers good opportunities for brand expansion in men's jewellery, much in the same way as we are seeing now in men's designer clothing and men's designer footwear and accessories. Sales of women's watches in China, with a share of just 25% compared to men's at 75%, are weaker than in other countries. Chinese urbanisation and the growth of dual working households may propel demand for women's watches in the short term. On a global level, there are a clear preference towards luxury watches over luxury jewellery if we compare these against their non-luxury counterparts. In 2013, luxury jewellery made up 15% of the total market, with high-end watches taking a more significant 37% share. Luxury brands and logos often feature prominently on watches, which may go a long way to explain why luxury timepieces ownership can be higher than jewellery ownership in countries such as China, where high-end brands are particularly esteemed. It may also help to explain why China's discouragement of extravagant spending is dampening demand for designer watches, more so than jewellery. Similarly, it is men's luxury watches that have taken the biggest hit, having increased by less than 8% last year, compared to 36% only 2 years ago. While, of course, some of this is thanks to China's slowdown in its wider economy, cutbacks in government spending are clearly a major contributing factor. But despite the category's resilience to such contagion, 2013 was still the weakest global performance in 4 years, indicating a possible warning that luxury brands and retailers need to unlock new markets. So, who is the luxury consumer? Moving away from the countries to look closer at the consumer, if there is one thing that we have learnt in the last 5 years, it is that brands need to re-evaluate their retail expansion and marketing plans and to take a more holistic approach to the luxury consumer, paying less attention to borders and more attention to the flow of money into other markets from wealthy tourists. Nowhere is the footprint of Chinese tourism more evident than in the luxury goods industry. While sales of hard luxury in mainland China account for around 10% of global sales, the Chinese actually contribute almost a quarter to the total global figure, according to figures from Global Blue. There is a strong correlation between the post-2008 resilience of luxury goods in developed markets and the growth in outbound Chinese tourism. For example, would luxury jewellery sales have increased by 20% in the UK in the 5 years to 2013 without a big influx of Chinese visitors? The simple answer is no. In fact, without wealthy Chinese, Russians and Middle Eastern tourists, the market in the UK would almost certainly have registered a contraction, along with France and Italy. A surge in the flow of Chinese tourists has also been a major contributing factor to the performance in the US. The Chinese made around 2 million trips to the US in 2013, compared with 500,000 in 2009. Over the corresponding period, value sales of luxury watches and luxury jewellery rose by 28%. Brand availability, status and price are all key drivers behind this trend. An identical luxury watch or branded piece of jewellery can often cost 40% more in Beijing, Moscow or Sao Paulo than in London, Paris, New York. It is therefore no surprise that the world's high net worth individuals choose to shop for luxury outside their domestic markets. Jewellery retailers, especially in the UK and France, are responding well to this trend by introducing things like China Union Pay terminals and employing Mandarin and Russian-speaking sales staff. However, with the UK being out of the Schengen area, it is unable to reap the full benefits of these tourists, which is really dampening sales and arrivals from China. Chinese luxury spend in Paris, for example, is 50% higher than in London. This disparity is only going to widen as France launched its fast-track visa for wealthy Chinese tourists in January 2014. So looking at how consumers shop, it probably goes without saying that bricks and mortar is the preferred channel for today's luxury consumer, with over 98% of luxury jewellery and watch sales taking place in store. Globally, the internet accounts for around 5% of all luxury sales, while in jewellery and timepieces, the channel share is less than 0.5%. Many of the world's leading luxury brands, especially those in hard luxury, have been slow in developing a digital strategy. However, there are a handful of high-end jewellery brands such as Van Cleef & Arpels, Boodles and Cartier, which have strong e-commerce platforms, selling pieces up to around £50,000. But with such a small online presence, where do luxury watches and jewellery fit in today's ever-evolving digital space? While online sales of luxury have remained low, there has been dramatic growth in social media, which has opened up new platforms for luxury brands to engage with consumers and is fast becoming the big new battleground for luxury jewellery and luxury watch brands. Rolex, for example, launched its first official Facebook page in 2013 and now showcases its latest products on YouTube. In the same year, Omega began building a presence on Instagram, with Cartier making big budget video advertisements for Facebook and for television. There is no shortage of digital innovation, and the ambition is clear. Mobile connectivity and social media are all the rage, and luxury brands want a piece of the action. And why wouldn't they? Over 1 billion people worldwide use Facebook, around 3/4 of them from a mobile device. Grabbing even a small percentage of that user base can dramatically raise a brand's visibility and help it to connect with a whole new generation of wannabe or future consumers. Social media is especially attractive to jewellery and watch brands because its core demographic is precisely where luxury brands need to recruit new consumers the most. So what can we expect in the future for luxury watches and jewellery? Increasing demand for higher quality branded watches and jewellery may be buoyed by income growth in the middle and upper ranges of the emerging markets. In the BRIC economies, the population with an annual gross income of over $150,000 is expected to expand by 195% between 2014 and 2030. According to our research, we expect sales of luxury watches and jewellery to reach 79 billion by 2018, adding an additional 16.5 billion on last year's figures. The key opportunities as far as overall spend is concerned over the next 5 years will remain in the top 3 markets of the US, Japan and China, but there are a number of smaller countries such as Indonesia and Malaysia which are showing pent-up demand for luxury brands and where spending power is on the rise. So a key message to luxury brands, therefore, is to pay greater attention to emerging markets, but more importantly, to the emerging market consumer, but at the same time, do not overlook the developed markets. Firstly, the world's wealthiest households will remain in the major developed markets, and secondly, luxury jewellery stores such as Graf Diamond and Asprey on London's Bond Street, or Van Cleef & Arpels and Chaumet at Paris Place Vendôme, or indeed Tiffany and Henry Bendel on New York's Fifth Avenue, will all continue to be desirable destinations for high-spending tourists from emerging markets.
you.